I believe that gold and silver will both do well for 10 years. Maybe I'm wrong. Maybe it's 5, but I think they'll do well from here. That doesn't matter to me. Silver outlived its usefulness. I'm less concerned about the government and the Hunt brothers than I am Rick Rule. And I want you to be more concerned about Daryl Thomas than you are the silver narrative. I remember when you and I first interviewed, you'd done a pretty good job getting yourself established. When we had that little bull market, 2019, 2020, you did pretty well. When that market went into reverse in 2021 and 2022, you, Daryl Thomas, felt bad. So I would urge you to take the steps along the way that will keep you from experiencing pain when this market has a cyclical decline, which it will, or when it experiences volatility. You're doing everything right now. Well, my theme song right now, to be honest with you, is I've been doing a little selling. As you know, Daryl, I've been telling you this for years. Whenever I buy something, I write up a little template to myself as to why I bought it and what'll cause me to sell it. Just very recently, I looked at my physical silver template, and I was buying the stuff at $18, $20 because I figured it would go to 50. I bought it as a speculative asset, not a permanent store of wealth. Lo and behold, I was wrong. It didn't go to 50. It went to 80. Suffice it to say, in terms of the role it played in my portfolio, it's outlived its usefulness, so I've sold it. Now, I think it's going higher. Make no mistake, I think it's going higher, and I don't care what I think. It is a speculative asset class, and I have decided that I have more torque in silver stocks than I have in silver. So I have sold my silver, and I've maintained my silver stocks. That'll get a lot of hate for us, Daryl. 5 years ago when I talked about silver and it was hated, people on social media said the guy's an absolute moron. The stuff's gone nowhere but down, blah, 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 blah. Now they're going to say the guy's an absolute moron. It's going to go up, not just through the roof, but to the sky, that kind of thing. That's all good. I don't care. But since you asked me, I thought I'd tell you. You'll recall, Daryl, that in October, I sold a quarter of my junior miners. By selling a quarter of my junior miners, I recouped all the capital I had invested in the sector, and I paid the capital gains tax. What that means is that for Rick Rule, I sold a quarter of my upside, and I got rid of all of my downside. And it's amazing how many people thought I was stupid for that. I don't figure the guy who ends up with the money is stupid.
An important distinction separates belief from strategy. One can be bullish on silver long-term and still choose to sell it today. Price momentum doesn't equal opportunity. As prices rise, future returns compress. That's when risk increases quietly. Instead of holding physical metal, leverage now exists elsewhere, particularly in quality silver equities with operational torque. This decision often draws criticism, but markets don't reward consensus thinking. History is full of examples where popular narratives ended badly. Multiple strategies can coexist in the same market, but each investor must understand which approach matches their goals, capital base, and risk tolerance.
I think maybe his disciplines are different than mine. My discipline is that I buy hate. I look for the easy money. His discipline is maybe that he's more of a pure speculator, or he buys momentum. There was a group when I was a young man, a long time ago, that tried the same thing. Their last name was Hunt. They were billionaires, and they learned they didn't have enough money as billionaires. So, there's room in a market for more than one strategy. I will tell you this, Daryl. You've heard me tell a joke about the bumper sticker in Midland after the oil crash. That bumper sticker said, 1984 after the crash, "God give me one more bull market. I promise not to waste this one." Well, if you ride it all the way up and all the way back down, which is what I did with the 1970s bull market, you have wasted it. I believe that you have to take money off the table and you have to reallocate it through the market. That's what I believe. I had the good fortune, probably relative to this gentleman who's going around buying silver at 75. I had the good fortune to buy a reasonable amount of it at 20 and below. I also had the great good fortune of being the largest shareholder of Sprott, which owns on behalf of other people $8 billion worth of silver and derives a nice management fee from it. So maybe my timing and my technique is different than this other guy. Suffice it to say, I'd rather be where I am than he is.
One of the most underappreciated skills in investing is locking in gains. Selling a portion of junior mining holdings earlier eliminated downside risk while preserving upside exposure. That move recovered original capital and paid taxes, transforming the remaining position into a risk-free opportunity. Many mistake this for weakness. It's not. It's risk management. Bull markets don't move in straight lines, and round trips destroy long-term results. History teaches that those who survive volatility with liquidity intact are the ones positioned to capitalize when fear inevitably returns. Winning isn't about being right, it's about staying solvent.
You're down to yourself, all right? First of all, I believe that gold and silver will both do well for 10 years. Maybe I'm wrong, maybe it's 5, but I think they'll do well from here. That doesn't matter to me. Silver outlived its usefulness. I'm less concerned about the government and the Hunt brothers than I am Rick Rule. And I want you to be more concerned about Daryl Thomas than you are the silver narrative. I remember when you and I first interviewed, you'd done a pretty good job getting yourself established. When we had that little bull market, 2019, 2020, you did pretty well. When that market went into reverse in 2021 and 2022, you, Daryl Thomas, felt bad. So I would urge you to take the steps along the way that will keep you from experiencing pain when this market has a cyclical decline, which it will, or when it experiences volatility. You're doing everything right now.
Every investor carries scars from previous cycles. Riding a market all the way up and all the way back down isn't noble. It's wasteful. Capital must rotate, not stagnate. Selling strength allows reinvestment during weakness. That's how wealth compounds. The lesson is timeless. Bull markets feel permanent until they aren't. Those who promise themselves next time will be different often repeat the same mistakes. The goal isn't to predict tops. It's to avoid becoming emotionally attached. When opportunity presents itself, action, not hope, separates professionals from spectators.
You are investing primarily in the Daryl Thomas brand around individual liberty and around natural resource investing, which is fantastic, and you need to keep doing that. With regards to your portfolio, you got to understand that you have to sharpshoot it. What you need to do is make yourself anti-fragile. You need to get yourself in a position where you have enough liquidity that when volatility occurs, you use it, as opposed to 2021, 2022, where you got used by it. Yeah, I get it. I get it. So don't remember that. I mean, don't forget that. Don't get yourself so elated. You know, when the price of a commodity doubles, Daryl, arithmetically, it's half as attractive as it was before it doubled. It's as simple as that. Gold only goes from 25 to 50 once. Buying it at 25 in anticipation of it going to 50, buying it when it's hated, that's where financially the easy money is, and psychologically where the hard money is. And the truth is, when psychologically it gets less hard, financially it gets more hard.
The objective isn't to eliminate volatility, it's to benefit from it. Liquidity creates anti-fragility. Investors who are fully committed during rallies often become victims during corrections. When prices double, assets become mathematically less attractive, not more. The best opportunities appear when assets are hated, not celebrated. This is psychologically difficult but financially powerful. Public excitement is often a warning sign. Smart investors prepare for downturns during upswings. The focus must remain on personal outcomes, not headlines or narratives. What matters isn't where gold or silver trades. It's how prepared you are when conditions change.
It's the right thing to do. Doesn't matter where it goes. It doesn't matter what happens to Nations Royalty. What matters is what happens to Daryl Thomas. Another thing, what you describe is true. Cody Penner did an absolutely superb job at my boot camp. I mean, he knocked the ball out of the park. And people after the conference were buying Cody Penner more than they were buying Nations Royalty. Now, what you learn about stocks that move on a circumstance like that, like if I go on BNN, apparently I moved B2 Gold, which is a $4 billion company, by 10%. But that's temporary. The furor engendered by an appearance wears off in 4 to 6 weeks. So if you see a pop in a stock during or after a conference, and you're thinking you might want to sell some someday, that's the day. That's the day. You know, I mean, there's 1,000 people who watched the Golden Triangle Boot Camp. They watched the Golden Triangle Boot Camp because they're looking for something to invest in. 1,000 new buyers got introduced to Nations Royalty at one point in time, and Nations Royalty has a very skinny float because Justra and the backers and the Nishka First Nations band own 85% of the stock. So only 15% of the stock trades public, trades in liquid fashion. 1,000 new people got introduced to it. And this young man, Cody Penner, I mean, talk about a future superstar. You got to interview this guy. He talks to them. And all of a sudden you had that classic circumstance where there was more buyers than sellers. But that doesn't last. The furor engendered by the recommendation subsides until they do a couple more prints, until they take their active advantages, which is to say their franchise and their knowledge, and do some more transactions. The value in that stock hasn't increased, only the price did. And so you made the right decision.
Successful investors study others, but never blindly imitate them. Billionaires can afford risks that would devastate smaller portfolios. Aggressive strategies work differently depending on scale, income, and emotional resilience. Some investors chase reward and absorb losses. Others prioritize risk control and let returns compound over time. Neither approach is universally correct. The key is adaptation, not duplication. Learn principles, not personalities. Incorporate what aligns with your circumstances and discard what doesn't. Investing isn't about emulating legends. It's about building a strategy that allows you to sleep at night, survive downturns, and grow steadily over decades.
You know, Eric, I've known Eric a very long time. And he is at once a very bright man, and he's a good man. People don't understand that. He's a very good man. And he's a courageous guy. So a few things. He's got a huge reputation. And he, in fact, can move a stock. He also can take complex stories and make them much more easy to understand. He is also a very aggressive guy. Eric is a legitimate billionaire. And while he would prefer to make money, Eric is willing to take 100% loss on a position that could give him a 10 or 15 to 1. What I'm trying to say is Eric's fiscal circumstance is different than Daryl's fiscal circumstance. So you need to employ the aggression that he does in the context of your own needs and portfolio. So the rest of the people who listen to Eric. I'll tell you a funny story about him, Daryl. When Sprott bought my business, Eric was a larger shareholder, and we were talking about our techniques, how we do things. And I said, our business is a high-risk, high-reward business. So I reckon if I manage risk, the reward will take care of itself. If I cut my losses and let my wins run. And he started laughing, and I said, what did I say that was funny? He said, nothing. But my technique is exactly the opposite. In a high risk, high reward, I chase rewards, and I figure my rewards will amortize my risks. Now, in a very bad year like 2012, Eric could lose half his portfolio. Half. Half a big portfolio. That doesn't change his decision as to what to have for breakfast. And psychologically, it doesn't change him. Most mortals couldn't lose a couple $100 million because they don't have it to lose. But if they did, they'd go over, crawl in the corner, and assume the fetal position and moan and whine. And Eric probably did that for 7 or 8 hours. But after that, he came out swinging. So it's important to note that you got to have your own style. You could listen to Eric Sprott's reason to own something, but then you have to personalize it. What are you trying to cause to occur for your family? What's your circumstance? What are your means? What's your risk tolerance? You follow what I'm saying? I mean, I learned watching Eric that there were some things he did that were useful to me. He pressed his wins harder than me. I still like the way I cut losses better. But what's important is, as I came to know Eric, what I learned is that I needed to incorporate, as opposed to copy, his techniques and ideas.